Hello everyone and welcome back to another video. In today's video, I want to go over Ray Dalio's most recent portfolio moves because he's been doing some really interesting stuff in the stock market recently. Ray Dalio is said to be the best macroeconomic investor in the world right now, so I think that it's pretty cool and important to see what he is doing with his portfolio because I think that it can give us some insights into what he is currently seeing in the market, in the economy, and just around the world right now. Ray Dalio has also been recently saying that he believes areas of the market are starting to get bubbly and frothy. So keep that in mind when we go through his portfolio because, again, he's been making some pretty interesting moves. With all that being said, let's just hop right into his portfolio and what he has been up to. Alright, so right here I have Ray Dalio's portfolio moves filtered from his largest positions downward. And right at the top here we can see that Ray Dalio's largest position is his S&P 500 ETF, which makes up 5.42% of his portfolio now. But check this out, Ray Dalio has sold 37% of his SPY ETF. That is a massive sell. He sold 1.16 million shares, which is over $500 million worth of selling. Now, why this is so interesting is because he has also been adding to his consumer staples and strong American brands pretty aggressively. He increased his position in Walmart by 45% and it's now his second largest holding. He also increased his position in Procter & Gamble by 47%, Johnson & Johnson by 65%, Coca-Cola by 45%, Pepsi by 49%, Costco by 49%, and McDonald's by 48%. Ray Dalio's portfolio looks like it left the overall S&P 500 and is now rotating into consumer staples and those strong American brands. Now this is very interesting to me for a number of reasons, so let's just go through them. The first reason I find this so interesting is because the weight of the top 10 stocks in the S&P 500 has been increasing dramatically and is now sitting at a 25-year high. I actually am not sure if the weight of the top 10 stocks in the S&P has ever been this high before. They now make up 28.6% of the entire S&P 500's market cap. So the top 10 stocks make up over a quarter of the total S&P 500's valuation. That is pretty insane. What this suggests to me is that more and more money is starting to concentrate into these top 10 stocks, and that the valuation of these stocks could be getting rather frothy right now. The chart here shows how concentrated the S&P 500 is becoming on those top 10 stocks. So to me, it looks like Ray could be trimming his exposure to the overall S&P 500 due to its increased reliance on these top stocks, and rotating money down here into some of the remaining stocks. If we take a look at Microsoft's price to free cash flow, for example, we can see that it is now approaching 40, which is an all-time high. Microsoft's price to free cash flow wasn't even this high during the tech bubble, and it reached 28 back then. This is because Microsoft's share price has been continuing to just climb higher and higher and higher, and it just seems like it will keep on going and it's just not going to stop. If we also take a look at Microsoft's price to sales, we can see that the price to sales is right near the tech bubble highs as well. So to me, I personally think that Microsoft is getting rather expensive right now. Now don't get me wrong though, I think that Microsoft is a fantastic business and I would absolutely love to own the stock one day. I'm just trying to point out that the stock's valuation, I think, is getting rather frothy, and this one stock makes up near 6% of the S&P 500. These factors could help explain why Ray has trimmed his S&P 500 ETF so much in the last quarter. The second reason that I could see Ray trimming his SPY ETF is because there's a growing concern that the Fed is going to start tapering bond purchases sometime soon. If this happens, then it would mean that bond yields could start increasing, which would harm stock valuations, especially stocks that are flying really high right now. Since the S&P 500 is concentrated on a few very large companies more than ever right now, and these companies' price ratios are sitting at all-time highs, I think this could ultimately lead to these stock valuations coming back down, which would bring the S&P 500 with them. Ray could be moving some of his money out of the high flyers and back into more value stocks, to try and de-risk himself against bond yields rising as we head into the end of the year. The third reason I could see Ray selling off the S&P 500 is simply because of inflation. Warren Buffett was asked what companies thrive during inflation at the 2015 Berkshire shareholders meeting. Warren's response was, "A brand is a wonderful thing to own during inflation." Now initially, this may not sound like anything too insightful or world-breaking, but the simplicity is rather beautiful. Take a look at McDonald's menu from 1970. A Big Mac was only 65 cents back then, and a coffee was only 15 cents. Feel free to pause the video and take a look at all of these prices if you would like, and think about how much all of these items cost from McDonald's today. What this suggests to me is that McDonald's brand has been able to keep up with inflation, and the company has been able to raise their prices with inflation and ultimately stay in business. I think that the reason for this is because people resonate with the brands they love, and reverting back to our favorite brands like McDonald's, Coca-Cola, or Pepsi is almost a habit for us. I mean, if I want a Coke, I am going to go and buy a Coke. And if the Coke is 30 cents more, I most likely am still going to buy it because, well, I want a Coke. I believe that this is why Warren Buffett says that strong brands are a wonderful thing to own during inflation, because consumers will continue buying their favorite brands even if inflation raises their prices. This could also be a reason why Warren Buffett has been continually building his Kroger position over at Berkshire Hathaway. It could also explain why Ray Dalio has been buying some of the best brands in America and really loading up on them right now. He built all of these positions by near 50% this quarter, which is nothing to joke about. I honestly think that this inflation theory is the one that makes most sense too, as Ray Dalio has been consistently preaching that he believes inflation is going to remain high for the long run. It's still just interesting to see that he decided to do this right now, and maybe the best explanation why he's doing this right now is a factor of all three, which could help explain the timing. On top of all of this, consumer staples have seen the least amount of returns across the entire S&P 500 so far in 2021. Literally every other sector has outperformed consumer staples. So if Ray is looking for value in the market right now, then it could be a decent place for him to find it. And again, this could also be one reason why Warren Buffett continues buying more Kroger shares. Now, the other significant move Ray is making in his portfolio is his purchase of VWO, which is an emerging market ETF. This ETF's top holdings are Tencent, Alibaba, Taiwan Semiconductor, etc. The VWO ETF actually looks like it's pretty Asia-focused and more China-focused than anything. I am sure we all know that China stocks have been rather out of favor lately, to say the least. Alibaba has lost nearly half its value from the highs the stock set in back in October of 2020. Tencent is also down roughly 50% from its highs in 2020. What this suggests to me is that Ray is moving more money into a diversified China ETF while these stocks are selling off and looking cheap. On July 30th, Ray Dalio actually wrote his view on all of the recent China regulations and why he thought investors are overreacting in the short term to all of this news. This is a pretty long write-up that he did over on LinkedIn, so I will just read the summary to all of you, where he writes, "As for investing, as I see it, the American and Chinese systems and markets have both opportunities and risks and are likely to compete with each other and diversify each other. Hence, they both should be considered as important parts of one's portfolio. I urge you not to misinterpret these sorts of moves as reversals of the trends that have existed for the last several decades, and let that scare you away." What Ray is saying here is that he believes both the American and Chinese markets have their opportunities and their risks. He is trying to tell investors that he believes there is still opportunities in China, and that we should not misinterpret the moves China is making or let them scare us away from the long-term potential of the Chinese economy. For those of you who may not know, China's economy has been growing more rapidly than the US, and China is now projected to overtake the US as the largest economy in the world within the next decade. The projections actually show that this should happen sometime around 2028 now. So to me, it seems like Ray is saying investors shouldn't outright avoid all of this growth, but rather should have a portion of their portfolios exposed to it. And to me again, it looks like this is what Ray Dalio is trying to do, and it looks like he has increased his VWO position to now make up just over 4% of his portfolio. What's also interesting is Ray increased his Alibaba position by 1% in the second quarter, and it now makes up 2.06% of his portfolio. So Ray's total China exposure looks like it is at least 6 to 7% of his portfolio as of the second quarter. I actually wonder if he has been adding more on the increased panic that we are seeing around China stocks, or if he is getting worried about all of the selling going on, because Alibaba is absolutely tanking. I'll have to dig through his Q3 filing when it comes out to see what he has been doing during all of this panic. Now, before I wrap up the video, I want to talk a little bit more about the emerging markets and why I think Ray is investing in them. This chart right here shows the global earnings growth across different markets in 2020 and 2021. Here we can see that China's economy didn't actually contract in 2020, and it still saw 4% growth last year, whereas US earnings shrank 13% in 2020. In 2021, China earnings are projected to see another 17% growth, and the US is projected to see 37% growth. Now check this out. Emerging market earnings only saw a 3% decline in 2020, and in 2021, they're projected to see a 50% increase. What this suggests to me is that the emerging markets are resilient as well as seeing massive growth. On the right-hand chart, we can see the forward price to earnings of different markets around the world, as well as their averages. The US is currently sitting at a 21.6 forward PE, which is well above the 16.6 average. China currently has a 15.9 forward PE, which is decently above its 12.3 average as well. But check out the emerging markets once again. The forward PE is only 14.1 right now, which is still well above the average of 11.8, but it's not incredibly far above. When I couple this with the fact that the emerging markets are projected to see the most growth this year, and they have the lowest forward price to earnings ratio, it suggests to me that the emerging markets could be presenting some really nice value right now. This next chart shows us the projected growth of the middle class and different economies over the next decade as well. 1995 is the gray bars, purple is 2020, and 2030 is the blue bars. What I am noticing in this chart is that India is projected to see the most growth to their middle class over the next decade. They currently have about 21% of their population in the middle class, and by 2030, this is projected to be 79%, which will actually surpass China. This ultimately suggests to me that the Indian economy will see massive growth this decade. It's actually projected that India will become the 5th largest economy in the world by 2025 and the 3rd largest by 2030. What I have done in my own personal portfolio is I have purchased an India ETF that tracks the growth of this nation. It's just another way that I am diversifying out of North America and trying to capture more growth around the globe. However, this is not financial advice by any means, and I am not a financial advisor, but if you are interested in diversifying out of North America and gaining exposure to more emerging markets, then definitely do your own research on India and look into the projections of this economy. But that is going to wrap up the video, everyone, and if you enjoyed this video or you found it helpful in some way, then as always, please remember to leave a like on it. It just really helps out my channel. Also, let me know what you all think about Ray Dalio's recent portfolio moves down in the comment section below. What do you guys think that he is doing by selling off so much of his S&P 500 ETF right now? Because it's a pretty substantial sell. But with all of that being said, thank you all again so much for watching, and I really hope to see you all again in my next video.